right. Yesterday we started the activity to view property, plant, and equipment. We saw the definition, the scope, uh, we saw the recognition criteria, and then we went on to measurement initially, and then we are on subsequent measurement. But before subsequent measurement, we started about the ways on how to acquire assets, right?
Yes.
Said you can acquire it by actually say purchasing. Maybe you could leave it, you could exchange it. Let's say you could use government grants, right? You could self-construct
Yes.
the asset, construct by yourself, right? But now he said that
Yes.
all the others were just direct on how to get the initial cost of an asset. But for exchange of assets, we said that we usually use fair what? Fair value. We said that if exchange specifies the exchange of items, regardless of whether the assets are similar, are measured at fair what? Fair
Fair
value.
value.
Yes, unless so usually we use fair value unless there are either of the two circumstances happens, and then we say that the fair value of neither assets can exchange can be measured reliably. This one is obvious. If you need to use fair value, but the fair value is not available, that one is obvious. We cannot use it. But then we say the most important point was here: the exchange transaction lasts for much what? Substance.
Substance.
And then I explained to you what is meant by the commercial what? Substance.
Substance.
I told you all these come from the concept of present value. Present present value. And I told you present value equals to the you take your future cash flows, let's just write CF, meaning future cash flows, and then you discount them, right, to the present
Yes.
value. And then we said 1 plus R power 1. Of course, I'm saying this, you won't find this anywhere mentioned, right? You know, that's my tendency. When I do study, I like to put everything into what? Into perspective. Then we said, when something
Yes.
lacks commercial substance, we look at three things: risk, amount, and what? And time. You may just say, right, risk, amount, and what? And time.
Time.
By amount, we mean the cash flow, right? The amount of the cash flow you expect. By timing, we mean this end, the number of years, number of periods, right? And
Yes.
then we have the risk. The risk is actually reflected in this kind of discount what? Discount factor. You know, they had the discount factor, they had the discount rate, the lower the present what? The present value.
Present
So it
value.
reflects the risk, right?
Okay.
Yes, so that's the point. And I think now you can understand what I do mean by what? If the exchange transaction lasts commercial substance, you may well say that, okay, no worries, I have no time to deal with fair value. I'll just focus on what? On the carrying amount. Because every asset should be having its carrying amount unless it has been depreciated to zero, right?
Yes.
Yes, so let's go down here now. What to do? Uh, this is what we're going to do. The points here, as you may see, it says the order of what? Of preference. But maybe let's just put something into a perspective. Let's say that you are having an asset that you want to give up, right? You give it up. G means give up, and then A means acquired. It means you are exchanging. You are providing G. You are providing G, and then you are getting what? A.
Eh,
So A will be your new asset, right?
Yes.
So let me do this. Let's presume that you have the fair values and the carrying what? Amount. Fair values of
Mm,
assets and the carrying. I just need to show you something here, which is just normal. Let's say that the asset
okay.
that you are having right now and you want to give it up so as to acquire another has a fair value of 10 million, while its carrying amount is 12 million. Okay, let's say its carrying amount is 9 million. And the asset you need to acquire has a fair value of 12 million, while its carrying amount is how much? Let's say it's 8 million. Let's presume this, right? So,
Okay.
in case the conditions have failed, and you are not going to use the fair value, that one would be no issue because I won't even touch this fair what values. I would just say, okay, right now I'm having asset G, right, with a carrying amount of
Yes.
9, and I'm acquiring asset A. It won't matter. You have to consider the asset that you are having and you are giving it up. So since asset G has a carrying amount of 9, even if I do acquire asset 8, I'll still record it at the same carrying amount of what? Of
9.
figure 9. Yes. That's what I'm going to do. Right. So the focus is on the share or is on the cost, is on the amount of the asset given up. Right. Now, let's say that maybe we also had the fair values and the conditions were just fine. Then I would say, I'm having asset G with the value of 10 million, but I need to acquire asset A with the value of how much? 12 million.
12.
Then I'll just say, okay, in my book, okay. Remember that in your books you will be having 9, right? That's what you're having. That's the carrying
Yes.
amount. But you are giving an asset worth 10 million in fair value, and you acquire one with 12 million. And and again, you won't focus on what you are acquiring. You focus on what you are giving up, right? What you are acquiring will just
Okay.
appear in the book by name, but there is for the amount will still remain with what? The asset you are giving up, right?
Yes.
So this is what I'm going to do. I'll be having number selling amount of 9, but now I will have to record the fair value of how much? Of 10. So
10.
this asset of A I'm going to acquire will be recorded at the amount of what? Of 10, right? Just as simple as that. So the main focus,
Okay.
and I'm repeating again, that's why you can see number one, the asset given up. In case this fair value is not available, then you will have no way, right? You will have to presume maybe the fair values are similar, then you will have to take this fair value of an asset given up. That's why you're saying, sorry, fair value of an asset
Okay.
was acquired. You have to say,
Acquired. Okay.
no way, right? It isn't like it is fine, but you will be having no way. That one will be the best approximation by that time, right? And that's why you say, in case none of them is available, you go back to the asset given up and you take its carrying amount as it is, just like that, right?
Okay.
Yeah, this is just a narrative I needed you to get a glimpse of it so that everything else gets better as we go on. So
Okay.
maybe okay, maybe we can do this. For example, there we say that we had asset C. Asset C had what amount?
It
Asset
was a carrying amount at 9 and the fair value it was 10.
Okay, carrying amount 9, fair value of 10. So this is what I'm going to do. I'm going to remove asset G from my books, right?
Okay.
An asset is of a credit nature. You get that one? An asset is of a
Okay.
credit what? Of a credit nature. Sorry, an asset is of a debit what? Nature. Assets and
Debit
expenses. Assets and expenses are of a debit what? Nature.
nature.
So to remove that asset, I'll go to my book and say credit asset G to asset G, right? You credit, you remove
Yes.
that amount of time, and then I'm
Okay.
going to recognize a new asset. So I'm going to debit it. Debit asset what? Acquired, which is asset
A.
A. By how much? By 10. So you can
10.
see how simple accounting is, right? To balance this one, you
Okay.
find out that the credit balance is still missing a single figure, right? And actually,
Yes.
and to remind you again, we usually start with debit and then credit when you do the double entries, right? So let's say I have a debit here,
Yes.
then credit what?
Yes. I was a bit confused.
Okay, so I'll be having 9 here. That one will be fine.
Okay.
And then after this is credit. Credit side is obviously overwhelmed, right? By 1.
Yes.
So
Yes.
the balancing figure should be on what? On credit, right? This one would be the one, the balancing figure. So it's up to you to know whether it's a gain or a loss, right?
Okay.
A gain is some sort of an income. And I told you, and you should take this if maybe you're not very sure of it. Assets and expenses have a debit nature, while the remaining items, which is income, liability, and equity, have a credit what?
Credit
A credit
nature.
nature. So since this is a credit balance, you say okay, this is paid an income, a liability, or equity, right? Since you are the one who has done this transaction, you will obviously know, right? Uh, this has happened just because I replaced one asset for another. Liability, right? Right? It's not like you have to pay
Okay.
the end money, so it's obviously not a liability, and so it's just what kind of income. I could just gain it, right? By exchanging, for my book, I've changed the figures from 9 how much to 10. So this will be the gain, and then I'll put here 1. By doing this, I will have eliminated asset review from my book. I will have recognized the new asset, which is asset A in my book. I will have my gain of 1 in the input. Right.
Yes.
Yeah, that's all about this one. I wanted you to have a bit of a concept before going into further. Okay, now we are on the crucial point now of I explain and we also
Would you
have
mind, sorry,
yeah,
I'm hearing you very low.
very low.
Yes.
Oh, what about
I've
now?
tried I've tried to put like 100, but it's still my speaker.
Your speak oh okay, so your speaker is low.
No, I've tried to put up to 100, but it's still you're still sounding low.
From the very beginning.
No, just on the middle.
Oh, just in the middle. You know, I thought maybe my microphone had an issue, but if it is a speaker issue, uh, okay. What about now? Still the same
Okay,
issue?
I can now hear you very well.
Okay, fine, okay. Okay, now
Yes,
let me resume, how to pause, okay? So now we move to subsequent what? Subsequent measurement.
measurement.
And now, when you're dealing with subsequent measurement, uh, remember that you already have your cost in the books now because we said initially we need to get the cost. So we told the deemed what? Cost. So we call it cost or deemed what? Cost, right? And
Yes,
subsequently now, as we studied about the meaning of carrying amount, we said it's cost minus accumulated depreciation minus accumulated impairment what? Losses.
impairment loss.
Now there is a lot more when dealing. So we have two models for subsequent measurement. You, the company would either be using the cost model or the revaluation what? Revaluation model.
Model.
We are going to see this. The revaluation model, as the word states, it uses fair value. But cost model doesn't use fair what? Fair value. Right.
Fair value.
Yeah, so for cost model is just obvious, it has no any problem. The cost model it says that carry the asset at its cost less accumulated depreciation and impairment what? Losses. Right.
Impairment loss.
So of course both of them should be accumulated even if it's not specified, but it's accumulated depreciation but also accumulated impairment what? Loss.
Loss.
Because you cannot choose between the depreciation, right? Let me take depreciation for year 1 and the year 3 and the leave others not. So it's obvious and accumulated what? Depreciation.
Loss.
And I told you for impairment right now, just be told this is impairment. But when you reach that standard, you learn how to even compute impairment, like I tried to show yesterday. And then you have the revaluation model. Now, this revaluation model, look where it says carry the asset at the revalued, not at cost, the revalued what? Amount,
Amount.
thing at the end of the date of revaluation, less any subsequent accumulated depreciation and subsequent accumulated impairment what? Loss. Can
Loss.
you compare the two and understand? They are exactly the same with the only with the only word subsequent happening. You see the word subsequent. It happens under the
Yes.
revaluation model, but it is not under the cost model. And this is the reason, right? You know, In case maybe you had an asset with a carrying amount of 9, if you are using the revaluation model, you have to revalue it first. You change its value to the fair value, right? Before taking it to the
Okay.
fair value, you will already have deducted all the accumulated depreciation so far, and then you would compare to the fair value. So, whenever you have
Okay.
your fair value, it means whenever you put an asset at the fair value as a deemed cost, all the previous depreciations will have been factored into it, right? So that's
Okay.
why whenever if you revalue the asset today to get the carrying amount, you take this fair value minus the depreciation and impairment losses from this point onwards. You no longer consider the depreciation and impairment losses which occurred before before using this fair value. That's what they mean, right? You got that
Okay.
point? Yes. So if you revalue the asset today, you would only deduct the depreciation and impairment losses after that date of revaluation. The previous ones are ignored. You would see when you do so, right?
Okay.
So that's the meaning behind this word subsequent. And so I told the revaluation model is available only if the fair value of the asset can be measured reliably. Obviously, the revaluation model uses fair value. So we see it well. This is a very important point. Okay, so for cost model, there is nothing much to learn there because, as I told you, impairment loss will be studied and on its own standard, and depreciation. Maybe it's just depreciation. You need to have a revision of the depreciation method. Hey,
Okay.
depreciation methods, of course, there are just usually common methods. You know about the straight line, right?
Yes.
Straight line and reducing balance. Those are the two common ones.
Yes.
Uh, Okay, now when we deal with the revaluation model, they're just trying to explain much more about the revaluation model. As I told you that it uses the fair value, and the fair value is usually obtained from what? From the market, right?
Market value.
Yes, yes. So maybe if you just try to show if you are actually preparing the financial statement, how are you going to get that fair value easily? You may even use independent valuers, right? There are people who specialize in valuing things, right? Hello?
Okay.
Yes. So that's the situation. But sometimes you may find that maybe you do not have the market on which to get that fair value. What are you going to do? So we just try to explain this. For example, they're just trying to give you a picture that maybe when a market value is not available, you do not have the market value. What do? It says you can use depreciated replacement cost. You know the meaning of depreciated replacement cost. Let me just give you a picture. Of course, I don't expect you to find this in an exam. This is what I mean, right? Let's say that
Okay.
an asset usually has a useful life of 10 years, right?
Yes.
And we say that maybe you have used it for 4 years. 4 years have passed, so you only remain with how much? With how many years?
6 years. 6 years.
And now you see that I need to get the fair value of this one. But when you go to the market, maybe the market will be having only new vehicles, right? So maybe it's the vehicle. We'll be only having new vehicles. Maybe there is no any vehicle that only has 6 years remaining. So they usually say that the best way is you go for the new vehicle that has a life of 10 years, right? You take its fair value,
Yes.
let's say it's 100 million, and
Okay.
then you depreciate it by the 4 years which have already passed.
Okay.
Yes. So you could find
Okay.
maybe something that you find that okay, I will use it by 30. So you remain with 70. So this is what we can call depreciated replacement what? Cost, right? Because you have no
Okay.
way of getting it. So you take the value of an asset with no depreciation,
Yes.
and then you account for the years that the asset has already been used. It's kind of an estimation.
Okay. Okay.
Yes. So that's and here now you're saying principal requirements under the evaluation model. Now, before going to the evaluation model, maybe I would like to hear something from on the depreciation method. I know depreciation method is very normal, but maybe I just need to ask you, right? I just need to hear
Yes.
something from you. How do you usually do that? So I need to hear from you about We said that there's a straight line method and reducing bounds. Those are the common ones, right?
Reducing them.
Can you
Yes.
see the formula for straight line? Would be
Yes. Yes. The formula for straight line is cost of an asset
correct.
minus a residue if you are given in the question
Okay,
over, yes, over the useful life.
okay, that's good. So, right.
Yes.
Okay,
So
yes, yes, I'm
yes,
listening.
so the reducing.
Yes, I'm listening. Listening.
Okay, yes. So after you have this formula, then you put the amounts. Example, I'll just take an example. Like we have bought a delivery van at a cost
Okay,
of 10,000.
okay, I got you. I got your point. That's good. I just needed to hear whether you can know how to get this. If you can get this, that is fine. Now, I'm just trying to stress, or of course, we're going to see it, but I just want to stress. Suppose, let's say maybe, okay, but no worry, I think we're going to meet it. We are going to meet a point where I will say, what if music price changes? What do you do? What do you do to the residual value of changes? And what to do if the cost changes after the cost never changes, right? Easily, until maybe you have added something. But there will be a way, maybe you have revalued an asset, right? And then
Mhm.
this changes. So we are going to see what you have to do when either of these three changes, right?
Okay.
Yes, so we'll see that. I just wanted to know whether you know about this formula. I know, of course, there are normal formulas, so it's good. And then what about for reducing balance? The reducing balance method?
A reducing balance method, you'll be given a percentage.
Uh-huh.
Let's say
20%.
10%.
Okay.
20%.
Yeah.
So what you do is you do the percentage that you are given with the cost amount. Then the amount that you find is the one that will be reducing from the cost amount
Great. Great.
yearly.
That's good. That's okay.
Yes.
But also, I need to tell one thing. Sometimes you have to be careful. If you are provided with a
Okay.
percentage, be careful. It may be a percentage, but still it may be straight line. Well, you know about that. You have to
Okay.
read the question. Percentage doesn't necessarily mean what? Reducing balance. For example, let's say use it cycle 5 years here, right? I'm just trying to,
Yes.
5 years, if you take, this is like when you do remove these figures here, we only remain with one above. 1/5 equals to 20% too, right? So I could have said this
Okay.
times 20%.
20%.
So if we a straight line, we would take that percentage and multiply by cost minus residual value. While for reducing balance, we never deduct the residual value, right?
Yes.
So it would be the same. So 20% is the same as someone telling you that use straight line for 5 years, right? Because 20 times 5 equals to 100, right? It's like someone tells
Okay.
you use it straight for 4 years, but it could tell you use 25%. 4 times 25 again equals to 100. So be
100.
careful on that. This shouldn't give you immediate break, right? If you're thinking that it's using
Okay.
salad. I needed us to just get a little glimpse on this. And
Okay.
now let's go now to, I wanted us to deal with this principal requirements of the undergrad evaluation model, but I want us to do something else. This is what I was speaking about now, review of music life and review of what? Of depreciation. So that should be something pretty low. Okay, okay, so regarding, okay, I think they are just little matters. There are some matters here are just little. I think I will do them when you are dealing with these revaluations and what you will find them automatically. No problem. Okay,
Okay.
now, yes, now let's go to the principal requirements under the what? Evaluation model. The evaluation model is actually something new to many people. So maybe it's the same one. Now, when you do the revaluation, at the preparation of the financial statement, you should note the following. First of all, the frequency of valuation depends on the volatility of the fair value. This is just the way it's right. If the fair value is very volatile, let's say maybe the fair value of an asset changes after a very short time, and maybe it changes by a material amount, the change would obviously be there, right? It wouldn't be fixed.
Yes.
But we also look at the magnitude of the changes. The changes may not be material, so it won't be a big deal actually adjusting to them. It will just be wastage of time. That's why I say the frequency of valuation depends on the volatility. Volatility, it means susceptibility to changes, right? Or the individual items of property, plant, and equipment, the more volatile the fair value, obviously, the more the frequency of the revaluation should be there, right? But also, we look at the value, right? That's why I told you, where the current value is very different, if the difference is material, right? It's where
Yes.
you do the revaluation, not when it's just changing. No. When it's material, then we change. As I told you before, accounting works on the principles of materiality. If something isn't material, which means that if it cannot impact economic efficiency of users of financial statements, then we are ready to ignore it altogether.
Okay.
Okay, so the first one just gives a glimpse of what to do. And then number two says, when an item of property, plant, and equipment is revalued, this is a very good point. The whole class, the whole what?
The
Class
whole class.
of assets which it belongs to be revalued at the same time to prevent selective revaluation. You know what some people do? Someone maybe may having four similar vehicles, but maybe someone observed that this vehicle, its value has actually increased, but maybe this vehicle, due maybe to some problem it has faced during work, maybe its value has diminished. So he revalues those ones, the values of which have appreciated, and then he does not revalue those, the values of which have what? Have fallen. That's not good, right? That's why to avoid that,
Okay.
we say that if you revalue one item, you have to revalue the whole class of such assets. Now, the problem comes to how do you know this is the class? How do you know it's in the same class? Because if I say the vehicle, okay, I could say, okay, this is the vehicle, this is the vehicle, so it's fine. Look what this
Yes.
now. If we say property, land and what? And equipment.
Equipment.
So first of all, you could say property as property has its own class. And I told you yesterday, property only means land and what? And the building.
Building.
If you value one piece of land, you have to make sure that you have value all pieces of land and the building, right? But let's say maybe, okay, plant and equipment, these are huge. Maybe in case of, let's say maybe you say just the plant and equipment, you have decided to put them in one class, then if you also revalue one, you have to revalue all. That's the principle that we have to follow, right?
Okay.
And now, okay, you have about